Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place.
Hi guys, Ed Gotham here for Opto Sessions. Today I'll be talking to the lovely Michele Schneider. Mish is an ex-commodity broker who is the co-founder of MarketGauge.com, where she serves as Director of Trading Research and Education. MarketGauge provides financial information and education to thousands of individuals as well as large companies such as Barron, Fidelity, Thomson, Reuters and Bank of America. Michelle's incredible career has included over 13 years as one of the only female members of several New York commodity exchanges in the World Trade Center, where she even brushed shoulders with the legendary Paul Tudor Jones. Mish also runs a discretionary trading recommendation service called MMA Advantage, designed for active investors. We have a riveting conversation about gold, clean energy, and also some key takeaways from her latest book, Plant Your Money Tree, A Guide to Growing Your Wealth, including her favorite phase of wealth creation. Okay, here we go. Hello, Michele. Welcome to Opto Sessions, and thank you very much for joining us on the show today. How's everything going?
Everything's going great. We're in the lovely southwest of the United States. It's a beautiful place to live, Santa Fe, New Mexico. And all's good. Market's up. Things are crazy. Market doesn't care. So no complaints.
Yeah, again, a very interesting time to be talking about the markets, as you said, very topical at the moment. Everyone's talking about them. I thought a good place to start might be in something that you talk about in your book, basically. So in your book, Plant Your Money Tree, you introduce a concept of the 6 market phases, which we're going to dig into in a bit more detail later on in the interview. But what stage do you think we're in today, and how do you think individuals should be positioning themselves from an investment perspective?
Well, what's interesting about today is that we're actually in a divergence of phases. You have the tech space and the S&P 500 more in the bullish phase, and then you have the small caps and the financial part of the small caps more in a negative or even bearish phase. And then we have everything in between. Right now, it's pretty well represented as what's really the phases are all about, to be able to see where on almost a compass things are so you can make decisions accordingly.
Okay, cool. So from a retail perspective, what do you think, should people be waiting until the phases it becomes more clear about where we're going, or this divergence, is that going to last, or historically what happens when in periods of divergence like this, it could give an indication of where we're going potentially?
Well, generally what happens with a divergence like this is that it does at some point reconcile. We were having these type of divergences in January and early part of February before we saw the pandemic swoon. And the winners were the negative ones, of course, the ones that were not quite catching up when NASDAQ made new all-time highs back in early February. Small caps were nowhere near close. The banking sectors were nowhere near close. The retail sector nowhere near close. And so it seemed at that point more an obvious bubble than what we have now, because something we didn't have then that we have now is a tremendous amount of stimulus, both from the government and also from the Federal Reserve, stating that they have more tools if necessary. So we're in a very interesting situation right now because we're still seeing tech go crazy and outperforming. But some of the weaker sectors, not all, are catching up a little bit, like the retail space, for example. E-commerce, of course, is doing well, but even some of the other chain stores that have an e-commerce presence, but yet people also still need to go to them and often do go to them, have done better. Transportation, which is real the demand side of the economy, doing better. Small caps doing a little bit better. Manufacturing numbers have been better. The big weaknesses still remain classical energy, oil and gas, and the banking, which is going to take the hardest hit because that's where the loan defaults happen.
Yep. And do the financials will they eventually, if they keep going the wrong direction, pull down tech as well, do you think? Or
I think it's very possible, not just because of the banking situation, where you're really seeing the reflection of the divide in the market between the haves and the have-nots, which of course keep growing. So really the question is, how long can the billionaires and the top 10%, really only very few people compared to the population of the United States are even involved in the market. At one point, does that actually, where you're seeing it in the financial stress, come home to roost? And it could be a watershed event like the upcoming election, tremendous amount of social unrest, which to this point has been mainly focused on racial inequality. I wonder at what point that goes to wealth inequality. And at what point do the corporations, which are just getting stronger and stronger and stronger in spite of any rhetoric coming out of the government saying that they're going to go antitrust, at what point does there become some sort of, maybe not storm the Bastille like we saw during the French Revolution, but some 21st century version of that? I don't know. That to me is the big question mark and the biggest thing that keeps me up at night if there's anything to keep me up at night about the market.
Yeah. I suppose that a question that came in my head at that point was, because I think in the US, are they stopping the, is it $600 unemployment benefit addition that that individuals received as part of the COVID sort of stimulus? I believe that stops end of August. Is that right? Or maybe
actually, it's sort of stopped already.
No.
Yeah, it stopped at the end of July. So here we are.
Could that be one of your catalysts? Or
absolutely. I mean, this is why I think it's going to be interesting to see how it plays out. The Republicans are well down in the polls. In fact, I just wrote this article for Optos magazine about the election, what could potentially happen. And as such, do they really have the wherewithal to hold money back from the US citizens, because it's not going to really help with their popularity? On the other hand, there could be so much confusion around the election with the idea of mail-in ballots and getting to the polls and et cetera, et cetera. It almost reminds me of a science fiction movie in a way, and I don't usually say this in interviews, so somehow I feel for you guys I can say this. It almost is playing out almost like, man versus the machine, although let's replace the machine with the large corporations who are holding most of the American GDP right now and most of the wealth, versus man, which would be, 2/3 of the country at least, that are really suffering through this pandemic.
Yeah.
Who wins? I don't know. In science fiction, there's always the group of rebels, but we know that the machines get a really strong hold, as they already are.
Mm. Well, thank you for that was a very interesting introduction to the interview. We'll come back now, I think, to a bit about your background. And if you could give us a sort of a brief overview of how you got to where you are today. I believe early on you were in your career, you were a teacher in New York.
Yes, I started out in life always wanting to be a teacher. I was one of these kids that would put all her dolls around my bedroom and then stand in front of them and pretend that I was teaching them. So I guess it was kind of, what I was born to do. And then I did become a teacher, and I was mostly interested in kids with disabilities. That's always been my interest, and actually not so different from what I'm doing now in terms of Wall Street and teaching about money and navigating the markets, because when it comes to money, a lot of people sort of become scared, which inhibits their full comprehension, as a nice way to put it. But anyway, so I became a teacher, and I did everything my parents wanted me to do. I was a good little girl from Queens, New York. And I got married. I lived close to home. I had all the plants that in the kitchen, and I cooked for my husband every night. And then I woke up one day and said, this isn't my life. This is the life that my parents dreamed for me. So one by one, I started changing things. I moved into Manhattan. I wound up getting a divorce from my first husband. And I stayed in teaching until I realized I was so broke. There was no money in special education. They were paying teachers poorly back then. And I met this girl who worked for Merrill Lynch. And she worked on the floor of the Commodities Exchange in New York. And she took a liking to me, and she took me down there. And it was one of those light bulb moments where I was like, oh my God. I was very young. I was in my young 20s. There were thousands of guys, young guys running around, and I loved the action. I always was really interested in math. I was good at it in school. And I just said, this is where I want to be. So it wasn't like that I got a job. I had to go through some hoops. Not being a woman was actually the least of the hoop. The bigger hoop was being a teacher. That old, those who can't teach kind of philosophy that people have, which is so wrong. But anyway, I managed to, with pure persistence, get a job working for a company called Continental Grain, Conti Commodities. And they put me right on the floor as an analyst, which was interesting because I knew nothing. But I learned.
And could you give us some insight into what it was like being one of the only female members of the New York Commodity Exchange in its heyday, I suppose, which is the most interesting part?
You know, it was a blast. I can't lie. I mean, it was just such a fun situation to be one of the few females down there. It opened up doors in some way because obviously I was noticed. On other levels, you ran into the typical sexism that one would expect, especially the old guys that were down there, who had been down there for years, and now they didn't want to see any women down there for no reasonable reason, just because who they were. So I ran into some of that. But for the most part, really, at the end of the day, if you were in the pits and you were willing to trade and add liquidity and take your knocks and take your profits and be one of the guys, not mind getting tussled about in the pits and stuff, after a while they forgot if you could have been a Martian. It didn't matter. You know, it was really kind of an interesting place to be for all types of people.
Yeah. And am I right in saying part of the reason you got into technical analysis is because it was at a time hard to compete with the men in the pit because it was quite physical?
Yes.
And difficult.
There were two things about me physically. I mean, one, I'm not a very large person to begin with. And not that every guy down there was big. There were quite a few guys that were like mountains in the pit. There were some smaller guys too, but the second and probably more prohibitive thing for me was my voice, because it was all open outcry. And if I would scream, it wouldn't really be heard. So I did a lot of whistling. I knew how to whistle, schoolyard whistle. That helped a lot. Yeah. And I would stand outside the pit very often, and that's where I started charting. I wanted to see how the prices were moving. So I used these point and figure charts, really a series of X's and O's. And from that, I started to see patterns repeating. And then I got really good at it. And then I got really well known as a good chartist. And men from all over, all the different pits would come to me and say, hey, Mish, what do you see? Blah, 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 blah. And then when I saw some interesting point, if it was too crazy, I'd actually pass in an order. I'd ask one of the guys to execute for me, or I would jump in there myself and, you know, not worry about the spit in my hair and, you know, the elbows in my shoulders and, you know, all of that. It was fun. It was fun. It's a young person's place to be. I could say at this point, I would never want to do it, but back then it was great.
Sure. And yeah, I'll probably go back round to now your book again, and which it was released last year. Is that correct?
Yes, it was released in May 2019.
Yeah, and it's Plant Your Money Tree, a guide to growing your wealth. And you go through a lot of interesting concepts in there, and I just wanted to dig into a few of those in a bit more detail. So, as I mentioned earlier, in your book, you introduced the 6 market phases as one of your key sort of systems. And are you able to give listeners a quick oversight of these and why they're important?
Okay, well, just to step back a little bit, because of my special education background, I was very, very interested in writing a book that was different than anything else that was out there. And it is completely unique in that it is not intimidating like a lot of technical books that people would not be able to get through. And it's not condescending like a lot of the wealth books, which basically in a sort of cavalier way say, oh, save your money, diversify your assets, passive buy and hold. I wanted to hit the sweet spot in the middle. So I wanted to give them a book that was easy to read and very anecdotal, so I could use personal experiences, conversational tone. And I wanted to come up with what I thought would be the one concept that had some technical aspect to it, because after all, we do need to have some technical background for these markets. Otherwise, you have to be Warren Buffett to be able to sit through long downturns. And that's where I came up with the phases. And the phases acts as almost like a navigation system in that if you want to know whether any instrument, whether no matter what it is, or the indices themselves, if you want to know what phase is in, it gives you information about that. So it tells you how to identify one of the 6 phases, whether you can determine if they're strong or weak, depending on physics, slope, and then what to do about those phases, whether it be in investments or what to send your kids to major in colleges, what's a good place for you to go if you want to change your business, what companies and what sectors of the economy may not be a good place to look for a job, like in oil and gas, for example. So I think it's a really good read if you don't really understand anything about phases, or even if you do, if you want to refine it. Because everybody knows about bullish and bearish, but there are these in-between phases that the smart money knows about, and that is really the best opportunities.
Sure. And are you I don't want to reveal too much, I suppose, from the book, but are you able to touch on a few of those, or are those best to leave for people who want to? We'll direct people to the book at the end of the show. So it's up to you.
Well, basically, I would say, if you were going to get something really out of the book, that's my favorite phase.
Yes. Okay.
I like to look at things at value. Momentum trading has also been absolutely fantastic, especially in 2020 with technology. But some of my best trades and some of my best positions that we've put our clients into have been ones that have come out of a long-term downtrend or out of a bearish phase. And they do what we call a recuperation phase. Some people will call it a recovery phase. This is really when the big institutional money starts coming in. And yet the public doesn't know about it. Okay. The public is usually, they sell at the bottom and they buy at the top. So this is really a wonderful inflection point, because you're getting in just as something is going back over a key moving average, and I use 2. And at that point, you have a very limited risk. And if it catches fire, you have a tremendous amount of upside. Yeah. Case in point, gold. We started buying gold when it was in this recuperation phase after it got hammered. And now, of course, it's in a screaming runaway parabolic bullish phase.
And how long do you see, when long-term trends start to start playing out, how long can these things last? I suppose we're also seeing it in technology stocks, and particularly the top 5 mega caps. How long can these things last? Like typically, well, not typically, but previously, there's been a lot of examples of things that last a lot longer than people probably think.
Absolutely. Well, and that's where you start to look at megatrends.
Yeah.
And that's also a part of my book, by the way, where I talk about 10 different megatrends. Our megatrends are something, we've had a couple of new emerge this year, given the pandemic. The work at home megatrend, of course, being a new one, something no one thought about when I wrote the book. But in a megatrend, if you catch something that's trending just as it's getting started, as I said, in this inflection, it could last a long time. So let's use another example. In 2012, semiconductors, which I like to look at, I like to use ETFs, not necessarily always to trade, because you can trade any of the instruments in the basket, but I actually like to trade the actual ETF itself. So SMH is the one I like to look at, chip technology, which has been around for a while. But in 2012, after it had really gotten beaten up post the 2008 recession, started to go through this recuperation phase. And since 2012, here we are 8 years later, it makes new highs almost every week. So there's something that's lasted 8 years. If you just would have bought it then and were kind of doing the passive investing type of situation, you would have done very, very well.
Yep.
At this point, you have to figure that everything has some level of a business cycle. It's possible that that business cycle at some point will come to an end. Now, if you're looking at something like gold, I wouldn't say necessarily could go up for years, but it doesn't matter, because it's the percentage of how much it goes up, even in the short period of time, that can just blow your mind and give you tremendous amount of profits. And it's an emotional type of trade. Most of the equities have some emotion to them, of course, and you see that in volatility increasing, but I don't think I've ever seen an instrument as emotional as gold.
Is that more retail, or is it all institutional money that's sort of driving the main sort of positive movements in gold, for example?
That's such a great question. I love that question, and I'll tell you why. Actually, the institutional investors have been sort of undervalued in terms of their gold holdings, believe it or not. And it's been mainly the retail investor that's been driving it. And one particular pocket of the retail investor that is come on the scene in the last year, and that's the Robinhood investor. And I am thrilled actually to see, because it reminds me of what it was like on the floor. When something would get hot, everybody would dash over to that pit and start buying. They didn't even know what the heck was going on. They just saw the volatility and the liquidity and they jumped on. And that's kind of what the Robinhood traders are doing now.
Yeah.
They were probably buying gold and silver, and they've been buying silver even more so because there's a social conscious aspect of silver. I'll get back to that. But they're adding the liquidity, and it's only now that the investors are starting to say, whoa, we should really be having more of our overall portfolio in gold. That's why it still looks like it's going to go way higher.
So we could potentially see further institutional investment now because they're realizing it's on it's all-time highs, isn't it? I mean, it looks like a positive trend.
Yeah, understatement, yes.
And you're seeing the same in things such as the cryptocurrencies are coming back. It's the same sort of dynamic, it feels, as things such as the gold move or what you see in some specific stocks that the retail investors have got a lot of excitement about at the moment.
Well, I think I like to look at it this way. I like to think of this as we're actually watching evolution here, reflected in the markets. I mentioned a little bit about science fiction, and perhaps that's why, they say that life imitates art, why so many of those movies have been really enthralled with the idea of technology getting out of control. And we're sort of seeing that reflected. But we're also seeing other things reflected, I think, and that is, when you mentioned cryptocurrency, because the idea of regular currency now is under suspicion. And the dollar, which has taken quite a big beating, could continue to go down, which at some point is not a good factor for the United States, especially with deglobalization and our diminishing reputation around the world. I think so that these kids, and I'm going to say kids, they're not all kids who are Robinhood traders, are bringing something new to the scene, which is this more socially conscious investing. So they're looking to get into things that they actually perceive, whether it's true or not, that will be good for the planet from the environmental standpoint, from the deglobalization and political corruption standpoint, and also from the standpoint of the fact that they want to have something physical they can hold on to, like a gold or a silver. And the cryptocurrency, which of course is nothing you really hold on to, but they don't look at it as regulated, which it's not, as you would any particular equity.
Yep.
But by a bank, I mean.
How influential can that group of people be? Because I haven't got the stats to hand, but I know what the institutional side is obviously a lot bigger in monetary terms than the retail side. But it's when they interact together that things really start to motor. And how influential on their own can the retail investors be?
Well, they've actually outperformed the institute. Get back to what we were saying with gold. In general, these retail investors, Robinhood investors and the like, have well outperformed so far 2020 than the institutional investors have, because they're old school. So they have to catch up to the times. And when they do, which they will, either that'll be the top, or we'll see one giant blow off in the areas that these retail investors are interested in. And then, we'll go through another cycle like we always do.
And so you've already mentioned as well that you sort of use ETF to track sort of phases of different areas. And so you mentioned the semiconductor ETF. Is it sort of the themes that you use to get a gauge of different areas and how they're moving? Is that right?
Yes, it's like if you think of it like a book, and you have your chapter and then you have your subtitle. To me, the chapter, of course, the title would be the market, and the subtitles would be the sectors as represented through the ETFs.
Yep.
You could tell that I'm a teacher, right? So almost like a textbook. And what's great about the ETFs is that because you can get a representation of different equities within that basket, if you have an earnings that comes up and one company in the basket doesn't report well, it won't necessarily mean that you are in dire straits being long that particular instrument if it comes in, say, 20, 25% lower. If you're in the ETF, it may get hit, but be maybe hit by 1 or 2% because it's probably going to tell you that other areas are doing well. Let's look at semiconductors. Perfect case in point. If you're long advanced micro devices, you are a happy camper. That thing just keeps rocketing to new highs. But Intel, which is also in the semiconductor space, has gotten creamed.
Yeah.
So there you go. Semiconductors are still making all-time highs. That's why I like to look at the ETFs.
Yep. Are there any themes that are most interesting? So you mentioned semiconductors, obviously, and is it another theme that's quite interesting to you at the moment?
I have quite a few. If I just had to pick in no particular importance of order, I would say the cannabis space really interests me a lot. It's gotten completely beat up.
Yeah, massive.
And so this is exactly what you and I were talking about. If you go into a long-term downtrend, it's actually cleared into a recuperation phase. And actually certain instruments in that area, like canopy growth, has gone into the next phase up, which is an accumulation phase. I do believe that what happens with the election is going to be a big impact. But even if we wind up with a Trump re-election, which anything is possible, there is also possible we get a blue wave in this country, and they are definitely more on the side of looking at federal legalization of marijuana.
Yep.
So we'll see.
And the best way to sort of take advantage of some of that would be through some sort of ETF.
Well, there is an ETF. It's MJ, Mary Jane. So I love the names of some of these ETFs. It hasn't done as well as, let's say, canopy growth that we just talked about. But nonetheless, again, it's a good way to put your money into an ETF that represents cannabis, have a stop in mind or a risk point in mind where, because it's possible to be wrong, and just kind of put it away. And this way you don't have to worry about earnings reports, et cetera. And if it does catch fire, particularly whatever happens in November, you'll be doing very, very well with that. And if you're wrong, you have to know where you're going to be wrong.
Yeah. And
you asked me about other places that I would look at.
Oh,
right?
Yeah. Outside of cannabis.
Yeah. I mean, listen, anything, if we have a liquidity crisis, which right now doesn't look like it's going to happen because the market is so hopeful about more stimulus, but if we did, everything would get hit. But on any kind of dip that we would have, because everything's a little extended right now, I also think you want to look at technology sectors that aren't Apple and Amazon. Rather, you want to see the emerging Apples and Amazons of the world coming up. And these are small cap companies, so they don't have the ballooning capitalization of an Amazon or an Apple. But they have a good balance sheet, so they're high growth small cap stocks. If you can find those in technology, they are very, very good to look at for the future. So that's something else. To give you an example, there's an ETF for that as well, and that's VVBK, which really is one of the areas, and IWO being another one that has a lot of the basket of these tech stocks that are small cap growth. So I like to tell that to people because I'm very excited about that area as a potential takeover for the next Apple and the next Amazon. And I'm also really interested in commodities right now, not just gold and silver, but raw materials in general, because you want to talk about underperformance, the food commodities. And what's the one thing that everybody in the world needs to do? Eat. We can upgrade our Apple phones and buy, Zoom technology, et cetera, like we're using today. But without food in your refrigerator, you're not going to make it. So food has been at 100-year low in terms of the ratio to equities. So we're already long soybeans, we're long sugar. We haven't gotten into corn or wheat yet, but we've been watching. There's another ETF, DBA, that's actually done pretty well over the last couple of weeks. I keep my eye there too, because with the dollar going down, with the deglobalization, with the supply chain disruption, with any type of environmental factor that could happen at any given time, whether it be drought in the United States or tsunami or locusts, which were a huge factor earlier in the year, you could see those food prices skyrocket.
Yep.
And they already have in the supermarket. They just haven't been reflected yet in the commodities market.
Yep. And in your book, you discuss some of the key economic components that you sort of use to help with your investment choices. Is the US dollar one of those? And how do you use that? And how, what in the current scenario, like you've been talking about, if there's devaluation in the dollar, what is the result on commodity prices, etc.? Just so give people an insight into that.
Well, we did talk about just before that the dollar, my biggest concern is losing its status at the world reserve currency. That when I first started saying that about 6 months ago, you wouldn't believe the backlash I got on that on Twitter. And now all of a sudden I'm seeing articles being written about it by macroeconomists, which of course never go by a macroeconomist timing of the market, but that's beside the point. So I do watch the dollar. I've always watched the dollar. And when the dollar actually bottomed back in 2014, I knew that was going to be very, very good for the market. I also saw that it was going to top this year, and I've said as much and written articles about it. And so at this point now, I've always watched the dollar, but now maybe more hyper-focused on it because of that fear where it's good, costs of goods are not so expensive. Oh my God, now all of a sudden it doesn't buy very much. And there's a glut of dollars on the market. And all of a sudden we're maybe dealing more in the euro. I mean, that's a possibility. The euro has skyrocketed over the last couple of months. I've suggested the yuan, and I get laughed at when I say that, but who the heck knows? It's really just something to watch. I watch interest rates as a key indicator constantly. Obviously, when I saw the move by the Fed, even before the pandemic hit, that they were heading down in terms of getting closer to zero, with central banks around the world already doing that, that's going to be a factor. And a new thing came up for me, well, not new, but more of an emphasis this year because of the Fed, and that is junk bonds, high yield grade bonds, but also high corporate investment companies. This is where the Fed has gone in and bought. They cannot buy equities yet, but legally that is, but they can buy corporate bonds, and they can buy junk bonds, and they can buy all kinds of things in that space, and they have. So that's another hyper focus of mine now, because if that risk appetite wanes at all, I think that could be a really good foreshadowing early warning indicator that the party is coming to an end for the overall equities.
Yep. Okay. Very interesting.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
What do you believe is the best way for a retail investor to consistently grow
what's the best? So do you mean what would I recommend a retail investor do?
Yes. Is it stocks? Is it, and that sort of, let's say someone who does follow the markets, they're not, they know what they're talking about, and they already invest. What is the best sort of overall strategy? Because it can become difficult to even like the choice of where you put your money. I mean, we've mentioned ETFs, etc. I was just wondering if it's a hard question, but if you had any ideas on that.
No, I think I have some very specific ideas on that. Well, for one is in terms of the retail investor, one of the reasons why I wrote the book was because of this navigation type system. So if you learn nothing else, it's always good to become a specialist in one thing. And I believe with all my heart, and this is nothing with me trying to promote the book. I wrote this because this is what I believe in, and this is how I trade. Become a specialist in the idea of these phases. Because this will prevent you from doing something that I'm really against and our whole company is against, which is passive investing. Mm-hmm. If you look at the history of passive investing, if you are close to retirement, as you told me, many of the demographics of your audience could be within 10 years of retiring, could you afford to sit through a 20 to 70% decline in the market? No, you can't. If you're 30 or 40 and you can sit through it and it comes back in 20, 30 years, great. And I say 20, 30 years because Japan is the perfect model. Japan peaked in the mid-80s, the Nikkei. And they did pretty much everything that the United States is doing right now. They started buying their own market. They've lowered the interest rates to zero. They did everything they could to support the market. And guess what? Here we are 35 years later, and it's still half of what it was at its peak.
Yeah.
So this is my cautionary tale to retail investors. Enjoy the ride while it lasts.
Yeah.
But be aware when the ride ends. And the easiest way to do that is to understand that there's a phase after the bullish phase called a caution phase. And when we hit that caution phase, that doesn't necessarily mean the end is nigh, but it certainly tells you exactly that. Pay attention and be somewhat cautious, because if it starts to deteriorate and any of the conditions that we're seeing, the volatility around the world, who knows?
Yep. That's a very good answer. Okay. Thanks for that. And in terms of Bitcoin, is that something that you guys look at, or cryptocurrencies? Is that something that interests you at all, or is it something you keep away from?
Both. Okay. Because a lot of our clients are baby boomer clients, they're terrified of Bitcoin. They don't get it. They don't see it traded actively other than a future or through one over-the-counter stock called GBTC. And that's an over-the-counter. Some people can't trade over-the-counter. So baby boomers are frightened by it, but that doesn't sway me from being very, very bullish. I actually believe that, the whole idea of paperless money, electronic currency, that is mined, that you can trade actively. And once we start to see more and more items being able to be traded within or paid for in Bitcoin or Ethereum or any of the alternative currencies, because Bitcoin is here now. It could change. It could become something else. So I'd rather say alternative currency. Yeah, I am really, really, really interested in that space, and actually recommended buying it at 4,000. Because I knew that wasn't going to go any lower at that point. And now at last look, I haven't looked at it recently. It went up to 15,000. So I don't know what's trading today.
Yeah, no. I think it is an interesting area. And you can see these sort of big innovations can take a long time to take foot, because they've got to displace something that's been in place for, centuries. So, yeah.
Right. And there's two other things that are starting to emerge from the younger generation. One is this whole idea of fractional ownership. Mm-hmm. And the other idea is not really owning many things that we considered in our generation to be necessities, because you'll be able to go on the street and put in your card, whether it's in Bitcoin or dollars, and take a car out for an hour. I mean, you can already do that in places. And I think those type of services are going to increase more and more and more, where your commitment is only on an as-needed basis, as opposed to you have to own it. Yeah,
no, I definitely can see that happening. And if we could just kick off with what sort of trader are you? What do you consider? How would you define yourself?
Well, I would consider myself a discretionary trader, number one, because we do have some really unbelievable quantitative models as part of Market Gauge that actually my husband and James Kimball, who is usually sitting behind me, had really basically programmed to follow trend strength indicators and momentum type trades. So I've become a bit of a hybrid trader in that we have money in some of these models that have caught these incredible moves that probably just my conservative nature would have never done on my own. Whereas I'm more looking, like I said, more for the value type investment, or I'm looking for things that are bottoming out over a period of time and then take out a certain level of a base, for lack of a better word to put it. I also am not just a technical trader. I really like to refer to the fundamentals. I want to have a fundamental reason of why I'm going to do something, like I just explained to you with cannabis. I bought cannabis because not only has it increased in terms of its legalization here and throughout the world, I do believe that will continue. Or I will look at a company, an individual company that I like for a particular reason. Beyond Meat is a perfect example. I can make a great fund, which reports earnings Tuesday, August 4th. So that will be interesting to watch too. But I make reasons for that. One, it is definitely the most recognizable plant-based product out there. Two, socially conscious investing. It has the attention of the Robinhood investors. It's had the attention from me for a long time because I'm a vegan. So it's environmentally good. And the company is doing well, making deals all over the place. So I will look at the fundamentals, but I won't make a trade without my roadmap, my navigation system. I don't want to get in if it's so extended because I can't control my risk. So the other aspect of my trading is risk reward. I'm all about the risk reward.
Okay. And are you able to give us an idea about your process for finding interesting opportunities in the market? How do you do that day to day?
Well, it starts with, as I said, I have these sort of mega trends in my mind. So I have places that I know I want to go, whether it's clean energy or geopolitical strife, or it's cryptocurrency or cannabis, or whatever it is. There's quite a few of them. Artificial intelligence, cloud computing, all of that. So I kind of have that in my mind. And then I look at the macro situation. So I will always check the 4 indices. I look for that divergence that we talked about at the very beginning. What are the small caps doing versus the NASDAQ? I look at the risk reward. Then I look at the key sectors. I actually have an expression for the ones that I find to be really interesting, which is the economic modern family. So I will look at the small caps, the transportation sector, the retail sector, the biotechnology sector, the semiconductor sector, and the regional banks, which I've been calling sort of the brat of the market right now. And I'll see how they're doing. So I look also for where money is rotating. Then I look at the dollar and I look at the interest rates. So all of that's in my mind, whether we're in a risk on or a risk off environment. That's really basically, to put it into 4 words, that's really what it is. Risk on, risk off. And then I will look at an individual stock and see if it's changing phases. So I can look at the risk reward and make a decision on whether or not I want to buy it. Like today's a great example. I am watching Fuel Cell. I just had to look up, sorry, I wanted to see where it was right now. I'm watching Fuel Cell, which is a very cheap stock. I don't usually trade stocks that are trading under $3. But it's gotten a lot of interest lately, and it's in the same family as Plug, which is also reporting this week. Fuel Cell's not reporting until September. So I'll watch. It cleared the 50-day moving average yesterday. It's in a good mega trend. It's right now holding the 50-day moving average, and if it closes near there by the end of the day, I know what my risk is. That would be something that I would trade.
And is this, I'm taking a guess here, but clean energy, renewable energy, is that stock related to that? Is that a trend you're following at the moment? Is it something you think's got legs to go further?
Well, we're in First Solar. If you were in, First Solar is doing, actually, I'm looking again, it's doing very well today. We've been in it for about $12.
Yeah.
We're already over $12 in profit. That also reports. Yeah, so I'll pick, or TAN, which by the way is the ETF, again, so aptly named, for the whole solar space. Now there's also PBW, P is in Paul, B is in Bob, W is in W. That is a clean energy ETF, also very extended, but doing very, very well. So yeah, I will look definitely for the things that I think are going to remain hot. And I do kind of peruse what the Robinhood traders are interested in, because not necessarily that I'm going to blindly follow them in, but if it resonates with me and I like the risk reward and the overall market is doing okay, why not? They're interested in Ford. I looked at Ford this morning. They're changing CEOs. That makes it interesting to me. It's basing exactly what you and I talked about. It's in a recuperation phase. So it's already been beaten up and now recovering. This is my process.
Yes. Okay. And are there sectors that you sort of at the moment actively avoid, or they're like, you would suggest people avoid them too? Maybe financials and stuff.
Well, things can change, but banks have been in a bearish phase. And so I'm continuing to avoid them. I think they can stay in a bearish phase while the rates are so low because banks are interest rate sensitive. And if the dollar continues to be weak, then I believe that banks will have to go through a major reconfiguration of how they do business, maybe embrace the alternative currency idea and regulate it more, possibly. So I'm kind of avoiding that right now, unless we start to see a flip. If the dollar starts to strengthen and I see the banks coming back over their 50-day moving average, again, risk reward, then maybe it would be a cheap opportunity to see if money rotates there. I also used to be an oil trader, by the way, on New York Exchange. After I was a coffee, sugar, cocoa trader, which, by the way, I almost took a job for EDF Man in London and was going to become the first woman trader on the London Exchange. But it didn't happen because I wound up meeting my now husband and stayed in the States to marry him. Personal story. But anyway, then I went to COMEX, which is the metals, and then I went to NYMEX. So I was an oil trader for about 7 years. And yet now I really try to avoid trading oil. Natural gas has looked a little bit more interesting because it's been so beat up, and it's not necessarily clean energy, but at least it's, well, except for the fracking part, it's not oil drilling. So yeah, those are the two things mainly that I'm avoiding right now.
Sure. And if you were to see the dollar to reverse and start trending up, would you foresee a decline in equities?
Well, if the dollar goes up, it will certainly impact the commodities, which right now, as I mentioned, are so undervalued, except if you're in the metals. That would make an impact. It would depend on how much the dollar went up for it to negatively impact equities at this point. But what it would probably mean would be that the yields might rise a little bit as well. And there's another slippery slope for the Federal Reserve because they have to stay accommodative right now. It's the juice that's keeping the market afloat. So yeah, I would watch the dollar only to see if that has a domino effect into changing the language of the Fed, which right now is in support of letting inflation heat up because they're looking at metrics that doesn't really represent reality, but so be it. It's their reality.
Yeah. Okay. And when you're trading or you're in positions or even looking for positions in stocks, you use the 250 weekly moving averages to make investment calls. Why are these so important to watch?
Well, I use the 50 and the 200 for the book.
Yeah.
And I do use it for myself, but that's only one of the time frames. We're looking, in your case, we're talking about a weekly time frame. So 50 weeks is about a year.
Yeah.
And 200 weeks is just under what would be a business cycle of about 4 years. And institutional investors look at the 200-week moving average very carefully. So if you want to make a longer term decision, you want to look at the weekly. I also look at the 50 and the 200 daily moving averages, and they're obviously a lot more fluid and faster because it's based on a 50-day lagging indicator or a 200-day lagging indicator. But I also look at monthly charts. I look at a 23-month, which is about half of a business cycle, an 80-month, which is about a full business cycle. And then I also look at some faster moving averages, like exponential ones on the weekly and on the daily, a 10-day. So really, it's almost like, if I had to use a metaphor, you know, when you would look to match things and everything matched up perfectly, then you would, you know, I remember as a kid playing with these cards that you had to find the patterns, and when the patterns matched, you know, then you kind of won and went on to the next thing. It sort of reminds me of that with all of these moving averages. If they all sort of point in the same direction, so if the weekly charts are bullish, if the daily charts are bullish, if the monthly charts are bullish, and the risk isn't too far away, that gives me the most confidence to get into an instrument.
Yeah. Okay. And when we talk about risk reward, because you've just discussed, it's only, you know, you only consider a trade when it's sort of in your favor. When some stocks are hitting all-time highs, in some scenarios potentially it's actually, you know, there's a lot longer to go, but others maybe not. So you know, the mega caps, Apple, etc., Microsoft, do you just avoid these altogether, or are some of them more interesting than others to you?
Well, this is where being a trader as opposed to an investor has a little bit of an advantage in that you can change time frames. So let's talk about Apple. Great example. Last week when Apple reported, it gapped up. It actually did what we call, from a technical standpoint, a runaway gap. A runaway gap simply means that it runs away from all of its historical price onto new time highs. As an investor, you could potentially invest there if you understand that if it breaks the low of the day that it gaps, it's time to get out. But most investors would be buying up there with the idea that Apple's just going to continue to go. And by the way, Apple's splitting. So if you bought 200 shares in August, you will have 4 times that, or 800 shares. That's to be aware of. But as a day trader or a shorter term trader, you can take advantage of something like that, buy that gap, have your stop or your risk right underneath the low. And then based on how much you're risking, so let's say you're risking $5 in Apple, when you get $10 or double what your risk is, or triple, some people like to look at, $15, you start taking profits. It's a very different mindset than the investing, I'm just going to get in and hold it. This is really a very, very calculated risk reward. And so we're talking about the reward part of the risk. And there are multiples versus what your risk is of where we take profits. We may look at 2 to 1 or 3 to 1 initially, then we like to look at 4 to 6 to 1, and then we like to look at 8 to 10 to 1. We may take off a little more. And then what we do is we trail up our stop so that we give a little bit of room for volatility to happen where we can still stay in the position, but not so much room that whatever we have left in the position turns into a loss.
Do you have a viewpoint on the Fed and how they've reacted to this, the recent market crash? We've talked about how they've been buying corporate bonds, etc. What this is something they haven't done before in such like aggressive nature. Do you think that has an impact on the market in the long term? Such, they're sort of interacting a bit much more than they previously have done.
This is another great question, and something that I haven't really talked about in interviews, so I'm happy to bring it up. There's a whole philosophy now, new philosophy from the old Keynesian type of economy to the modern monetary theory, MMT. Have you heard about that?
Yes, yeah, I have. That's Ray Dalio, is it?
Well, he really has been talking about it, but yes, it's being embraced by a lot of people, and even some economists at this point, but they're considered to be very radical still. And when I first heard it, I thought, hogwash, that'll never happen. But now that I'm experiencing what the Fed is doing with the burgeoning debt, I'm starting to look at that philosophy a little bit more. And this is where the Fed really fits in, because essentially what that philosophy is that debt doesn't matter. It doesn't matter at all. As long as the country is solvent, it can go into as much debt as it needs to stay afloat for the economy. And that is exactly what the Fed basically has embraced. Yep. Powell just keeps borrowing more money and printing more money, and the money supply and the debt keeps growing. And yet he's doing it to keep the economy afloat. So I think that that's really another area to watch, as sort of maybe if everything else I talked about is inside the circle, this is really the thing above the circle is MMT really going to work? And will the economy truly stay afloat as a result of it?
Yeah, we will see. I just wanted to finish with a quick fire round of questions that just brief answers, and it's just an interesting one to finish on, basically. So first one is your top tip for newbie traders?
Find a mentor that you can trust. I had many mentors on the floor. I would have never become the trader that I am now if I did not find the smartest people there and learn everything that they know.
Yeah. And a favorite book, apart from your own?
Well, now you're talking about trading book, so I really couldn't think of one. So
it was more whatever comes to, it doesn't have to be a trading book.
Well, you know what comes to mind? Count of Monte Cristo is my absolute favorite book of all times. And I've actually, the only book I've reread several times. I just love it. I think it represents as metaphor everything about humankind, including really what drives the markets and what drives people.
Yeah.
Greed, envy, despair, hope, etc.
Very interesting. And how do you wind down after days trading? Or do you have any sort of routine you follow?
Well, first of all, there's never really an end of the day when it comes to being what I do, because not only am I trading and watching what happens when the European and the Chinese markets open up, not that I'm trading all night long or what they call pajama trader, but when I do finally take a break, I love to cook, I love to hike, I love to watch these unbelievable Netflix series on TVs that have come up, particularly period pieces and Amazon Prime. And I love to hang out with friends. I need to have human contact, which of course most people need to have right now. So even though socially distancing, we are trying to get together with friends in the backyard and forget about all of this and just be like a person.
Yep. And where or who, if any, do you go to for market insights? Is there somewhere you go to?
Well, you mentioned Ray Dalio. He's definitely, I actually know him personally because he lived and worked right in the same.
Oh, I saw this when I was doing some research. Yeah, you worked opposite him or something?
Well, my husband did. And we partied with him a couple of times. Also, Paul Tudor Jones, who I know personally because he was on the floor when I was on the floor.
Really?
Yeah, so I read everything he says. I mean, he actually, a year ago, like I, was starting to look at gold and the risk of the dollar. So I adore him. And believe it or not, my husband, Keith Schneider, is really somebody who is so brilliant and has been trading longer than I have and made all these models, reads incessantly, knows everything. And so he's my go-to for details.
Yeah. And do you have a favorite charting software?
Yeah, we have an indicator called Real Motion. And I absolutely love it because it's sort of like a secret way to see when things are about to diverge. So for example, NASDAQ, which is doing very well near the highs, showed a divergence in the real motion indicator. In other words, the momentum isn't going up as much as the price.
Yeah, okay.
So I love that because it's something that nobody looks at except for the people who are our customers and have this particular indicator. So that's one of my favorite. Right now, it's my indicator of the day.
Okay. And last one was top tip for your younger self.
I thought, I saw that you were going to ask me that question. I had to really think about that because I was pretty bold and brazen. I went down to the commodities exchange floor knowing nothing as a woman, no money in my purse. So what would I have to think of? I think that the number one thing now would be we all live to a certain age based on the story of what we think our parents created for us. And we all have the power to create our own story. And I think the younger you do it, I wish I had done it earlier, the better you are.
Yeah, that's a good one. I like that. Also, thank you so much for being on the show, Michele. It's been a pleasure having you on there. Where's the best place for our listeners to go buy your book? Is it just going to Amazon or somewhere else?
Well, if you go to our website, marketgauge.com, there's a banner that comes up immediately. And the reason why I mentioned to go there is even though you wind up buying it from Amazon, we offer a bonus video of about 45 minutes where you can actually hear me talk about the phases. So that's what I would do. Okay, brilliant. And if you want to talk to me directly, I'm very active on Twitter. @MarketMinute is my handle. And so that would probably be the easiest and fastest place to get me. Perfect. That is all. And yeah, thanks so much for giving the time to us today to run the interview. We will give you any feedback we get from our audience. And thanks again. See you next week, guys. Well, thank you so much, Ed. It was such a pleasure. And thank you all for listening.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.